Warren Buffett is sitting on a mountain of cash. Let that sink in for a moment. The world's most celebrated investor, a man whose entire philosophy is built on owning productive American businesses for the long term, is now holding more than $300 billion in cash and short-term treasuries. This isn't just a rounding error or a temporary holding pattern. It represents a deliberate and significant strategic shift. For decades, the Oracle of Omaha has preached the gospel of being fully invested, warning that cash is a terrible long-term asset that gets eaten away by inflation. So when a man who has built an empire by buying, not holding, decides to stockpile an amount of cash larger than the GDP of many countries, the world must pay attention. This monumental cash hoard isn't just a quirk of Berkshire Hathaway's balance sheet, it's a message. It is a loud, clear, and arguably ominous signal being sent to every investor, from Wall Street titans to individuals managing their own retirement funds. You have to ask yourself a critical question. What does he see that the rest of us are missing? Why, in an era where markets have consistently climbed higher, is the master of value investing choosing to sit on the sidelines? This isn't just about waiting for a good deal to come along. This is about something deeper, a fundamental reassessment of risk and reward in the current economic landscape that could define the next decade of wealth creation. The implications of Buffett's stance are particularly resonant for one specific asset class: real estate. For years, property has been the go-to investment for building tangible wealth, a reliable engine of prosperity fueled by low interest rates and a seemingly unshakable belief in ever-rising values. Many have built their fortunes on the back of leveraged real estate, assuming the music would never stop. But Buffett's actions suggest a different tune is beginning to play. His massive cash position is an implicit warning that the very foundations of the investment world are shifting, and assets that seemed safe just a few years ago might now carry hidden dangers. Could real estate be the asset class most vulnerable to this new reality? This will dissect the layers behind Buffett's $300 billion alarm bell and explore its profound consequences, especially for the real estate market. We will uncover why holding cash, once considered a financial sin, has suddenly become a strategic masterstroke in today's environment. More importantly, we will translate the Oracle's wisdom into a practical playbook for the next 10 years, revealing why cash might not just be king, but could become the ultimate weapon for crushing an over-leveraged and overvalued real estate market. Understanding this warning might be the single most important financial decision you make for the decade ahead, protecting your capital and preparing you for the opportunities to come. Berkshire Hathaway's cash pile has surged past $300 billion. This is a conscious strategy. Warren Buffett has been a net seller of stocks, trimming even his massive Apple stake, signaling that attractive opportunities are scarce. Instead of forcing investments into an expensive market, he is choosing to wait, earning a respectable return while exercising immense discipline. This behavior is not new for Warren Buffett, it's a recurring pattern. We saw this in 1999 during the dot-com bubble. While ridiculed as a dinosaur, his cash hoard became his greatest weapon when the bubble burst. History repeated itself in 2008, where he became the lender of last resort to a desperate system, injecting billions into titans like Goldman Sachs. When Warren Buffett sits on record cash, what does he see? For Buffett, cash is not passive, but a strategic position, the conscious weaponization of patience. This cash pile is both a defensive shield against a market correction and a coiled spring, ready to be deployed when others are fearful. He is simply waiting for his pitch. Here is a simple, uncomfortable truth many participants in today's market are choosing to ignore. Assets are expensive. This isn't just a feeling, it's a quantifiable reality backed by historical data. The stock market is trading at dangerously elevated levels. Warren Buffett has built his entire legendary career on two simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Right now, the high price of entry into the market makes adhering to that first rule exceptionally difficult. When you buy into an asset at a peak valuation, the risk of significant permanent capital loss is not just a possibility, it becomes a probability that a prudent investor cannot disregard. Let's break this down. Think of buying a stock as buying a small piece of a business. The price you pay for that piece should be rationally related to the profits the business generates. One of Buffett's preferred metrics is total stock market capitalization divided by GDP, often called the Buffett indicator. This metric currently sits in territory that has historically preceded major market downturns. It suggests stocks have detached from the economic reality they represent, floating instead on a sea of optimism and momentum. This issue of overvaluation extends to more conventional metrics as well. The S&P 500's price-to-earnings ratio is hovering around 24 to 25. The long-term historical average is closer to 15 or 16. Investors today are willing to pay roughly 60% more for the same dollar of profit than the century average. This isn't just a minor deviation, it's a significant premium that bakes in heroic assumptions about future growth and profitability, leaving very little room for error or disappointment. For an investor like Buffett, who is laser focused on finding value, this environment is a barren wasteland. His approach is not to chase what is popular, but to seek out what is cheap relative to its intrinsic worth. He wants to buy wonderful businesses at a fair price. That task becomes nearly impossible when the entire market is priced for perfection. The high valuations mean the margin of safety, the discount between market price and intrinsic value, has all but vanished. Without that margin of safety, investing transforms from a disciplined enterprise into a speculative gamble. Buffett has steadfastly refused to gamble for over 70 years. Wow, that discipline is everything. To grasp why Buffett holds cash, understand that a high starting valuation acts as a gravitational pull on future returns. Even if a business performs well, you get mediocre results if you overpay. Buffett's rule is to avoid the permanent loss of capital that comes from overpaying. By holding cash, he is simply refusing to play a game that is rigged against him by high valuations. But there is another, even more powerful force at play that explains Buffett's historic cash pile. It's a fundamental shift in the financial universe, a change so profound it rewrites the investment playbook of the last 15 years. For the first time in a generation, cash actually pays. From the depths of the 2008 financial crisis until the Fed's aggressive hiking cycle in 2022, the world operated under zero interest rate policy, ZIRP. During this long era, holding cash was a fool's game. With interest rates pinned to the floor, a dollar in a savings account earned effectively nothing. When you factored in even modest inflation, holding cash meant you were guaranteed to lose purchasing power year after year. It was a financial penalty for being prudent. This created a powerful, market-distorting incentive known as TINA. There is no alternative. Investors were forced to take on more risk. Giant pension funds, retirees managing their nest eggs. Money was pushed into stocks, bonds, real estate, private equity, venture capital, cryptocurrencies. This relentless flood of capital searching for a home inflated the prices of nearly every asset class on the planet. It created what many have called the everything bubble. Stocks soared to record highs, bond prices rose and yields fell, real estate values detached from local incomes. Even unprofitable technology companies were awarded multi-billion-dollar valuations. Now that entire paradigm has been shattered. The Federal Reserve, in its battle against soaring inflation, has hiked interest rates at the fastest pace in decades. Suddenly, the financial landscape has been completely reconfigured. The foundational assumption that cash is a worthless asset has been turned on its head. Short-term, risk-free US Treasury bills are now yielding 4% to 5% or more. This isn't a trivial change, it is a revolution. The era of TINA is dead. Today, there is an alternative: cash. This single fact unwinds much of the logic that propped up asset prices for more than a decade. Every investor must reevaluate their entire strategy. For Warren Buffett, this is a return to a more rational world. He's long warned about speculative excesses from 0% rates, comparing it to a financial gravity that distorts valuations. With rates now at more historically normal levels, the fundamental calculus of investing has changed. The hurdle for making a new investment has been raised significantly. Why take on the volatility and uncertainty of the stock market for a potential 7% return when you can lock in a guaranteed 5% with zero risk? This new reality rewards patience and punishes recklessness. It is the perfect environment for a disciplined value investor who has been waiting for sanity to return to the market. The critical insight to grasp is that a 5% risk-free rate of return changes everything about how assets are valued. When cash yields nothing, assets are priced in a vacuum. But when cash offers a competitive yield, it becomes a direct competitor to every other investment. Think of it from Buffett's perspective. If he is considering buying a stock, he isn't just comparing it to other stocks anymore. He is comparing it to the simple, safe, and substantial return he can get from his mountain of cash. An investment in a business must now offer a prospective return that is significantly higher than 5% to compensate him for the additional risk. This is a much higher bar to clear than it was just a few years ago. This new competition from cash puts immense pressure on other asset classes, particularly those that have become overvalued. Consider a blue chip stock with a dividend yield of 2.5%. In the ZERP era, that 2.5% looked attractive compared to the 0.1% you might get from a bank account. Today, it looks paltry compared to a 5% risk-free treasury bill. For the stock to be a compelling investment, it must promise substantial future growth in its earnings and its dividend. This forces investors to become much more discerning. The days of buying any stock simply because stocks go up are over. Now, fundamentals like earnings, cash flow, and valuation matter immensely. The same logic applies with even greater force to real estate. For years, investors piled into rental properties. They justified high purchase prices with low mortgage rates. Rental income, however small after expenses, was better than nothing. But now, that calculation has been upended. A property investor must now consider if the net rental yield, after accounting for taxes, insurance, maintenance, and potential vacancies, can it meaningfully compete with a simple, hassle-free 5% return from T-bills? In many overpriced markets today, the answer is a resounding no. This makes real estate far less attractive to new capital and puts existing, over-leveraged owners in a precarious position. This is the interest rate revolution in action. It reintroduces the concept of an opportunity cost to the investment equation. Every dollar invested in a risky asset like stocks or real estate is a dollar not earning a guaranteed 5% in cash. This shift in thinking naturally cools speculative fervor and places a premium on genuine value and safety. It is precisely this environment that Warren Buffett has been waiting for. He can now sit back, allow his cash to generate a massive, risk-free income stream, and wait for the prices of other assets to fall to a level where they once again offer a compelling reward for the risk involved. He is not forced to invest, he is being paid to be patient. Section 1. The final lesson from the Oracle. Warren Buffett is now in his 90s. He has navigated the treacherous waters of the global economy for over 7 decades. He has witnessed every conceivable boom and bust cycle. Stagflation of the 1970s, the shocking Black Monday crash of 1987, the irrational exuberance of the dot-com bubble, the systemic collapse of the 2008 financial crisis, and the unprecedented disruption of the COVID-19 pandemic. After a lifetime of experience, he is not shouting from the rooftops or issuing dire proclamations. Instead, he is delivering his most potent message through his actions, through the silent, profound statement of a 300 billion cash hoard. The lesson is simple, timeless, and more important now than ever. He is telling us to be patient. He is reminding us to be disciplined when speculation is rampant. He is urging us to prioritize the preservation of our capital above the reckless pursuit of fleeting gains. And most critically, he is teaching us to wait for our pitch. The market does not serve up unmissable opportunities every day. The market does not serve up unmissable opportunities every week. The market does not serve up unmissable opportunities even every year. The truly generational moments to build wealth are rare, and they almost never arrive when market sentiment is euphoric. They emerge from the ashes of pessimism when fear has replaced greed and blood is in the streets. Waiting for that moment is not passive. It is the most active and strategic decision an investor can make. For more than a decade, the financial world operated under the dangerous illusion that cash was trash, a worthless asset eroded by inflation. Buffett's current stance definitively refutes this dogma. He has proven that when risk-free yields are real and asset markets are priced for perfection, cash is transformed. It becomes a shield that protects you from drawdowns. It becomes a tool that generates its own substantial income. And it becomes a coiled spring, storing kinetic energy that can be unleashed with tremendous force when the time is right. The greatest opportunities do not come when everyone is optimistic. They come when the over-leveraged and the unprepared are forced to sell their best assets to survive. So, as you look toward the decade ahead, you are faced with a fundamental choice. You can continue to chase today's returns, paying historically high prices for stocks and real estate, hoping the music doesn't stop. Or, you can heed the Oracle's quiet counsel. You can prepare for opportunity tomorrow by cultivating discipline today. Warren Buffett, with his 300 billion war chest, has already made his choice. He is sitting in his fortress of liquidity, collecting a 5% yield, patiently waiting for the next great crisis to deliver the next great opportunity. The only remaining question is, will you be ready when it comes?